A 62-year-old couple had $188,200 of retirement income last year and paid $0 in federal income tax. At the same time, they converted over $30,000 from their traditional IRA to Roth IRA, also tax-free. And they did all of this legally. How is that possible? There is a specific combination of strategies, and I'm going to show you exactly what they are. If you're new to this channel, hi, I'm Rosanna Quinnan, a chartered financial analyst and founder of QuinVest. And after working with hundreds of retirees, I've developed a planning system that helps you use the tax code strategically to enjoy the lifestyle you've earned without leaving money on the table. That's why I'm making this video today, to show you the specific rules that made this tax-free income possible for this couple, how they actually apply them in their situation, and the critical mistakes that could cost you thousands of dollars if you get this wrong. Because here is the thing. Done right, this strategy can save you hundreds of thousands of dollars in taxes over your retirement. Done wrong, however, it can trigger unexpected tax bills, reduce your healthcare subsidies, or increase your Medicare premiums. So stay with me through the end, and I'll show you not just the strategy, but how to know whether it's right for you. So let's get started. First, let's go through the foundation. The standard deduction. For 2026, if you're married filing jointly, your standard deduction is $32,200. That means you can have $32,200 of income, and it's completely invisible to the IRS for tax purposes. Zero tax. Now, here is where it gets better. Once you turn 65, you get an additional deduction, an extra $1,650 per person. So for a couple where both are 65 or older, that brings your total standard deduction to $35,500. But wait, there is actually more. Under the new tax bill, if you're 65 or older, you qualify for an additional $6,000 senior deduction only through 2028. And again, that's per person, so $12,000 per couple. This is available as long as your income stays under $150,000, and then it phases out. So if a couple were 65 instead of 62, they could potentially have over $47,000 of income completely tax-free. But at 62, they're working with that $32,200 base amount, which is still incredibly powerful when you use it strategically. The second piece of this strategy is capital gains harvesting. And this is where most people get confused. So stay with me for a second. For 2026, if you're married filing jointly, you can have up to $98,900 of taxable income and pay 0% on long-term capital gains. Zero. Again, it's long-term capital gains, which means that you have held the security for over a year. Now, here's the key. This $98,900 sits on top of your standard deduction. So we're really talking about $98,900 plus $32,000 of standard deduction, which gives you about $131,000 of total income you could potentially have with zero tax. And here is what's critical to understand. When you sell stock or mutual funds from your brokerage account, only the gains portion counts as taxable income. So if you invested $40,000 and it's now worth $100,000, only $60,000 gain is taxable. The return of your original money is invisible to the IRS. This is what makes this strategy actually work. And the third strategy is tax loss harvesting. And this is your flexibility tool. If you have investments that are down, you can sell those at a loss. Those losses offset your gains for $1. And if your losses exceed your gains, you can use up to $3,000 of those losses to offset ordinary income, like your IRA withdrawals. Any remaining losses carry forward to future years. So in a year when the markets are down, you have this tool to rebalance your portfolio and create additional tax efficiency. It's another lever you can pull. So let me show you exactly how this works with a real couple, Joe and Linda. They're both 62, just retired, and they need $13,000 a month to cover their lifestyle. That's $156,000 a year. Here's what they're working with. They have a $700,000 brokerage account. Now, they've been investing in this account for years, and about 40% of that, roughly $280,000, is the original invested capital. The other $420,000 is gains. They own a mix of ETFs and some individual stocks with very low cost basis. They also have have about $1.2 million in a traditional IRA and 401k accounts, all pre-tax money. And they also have about $170,000 in Roth IRAs. As you can see, they've done a fantastic job building up money in different buckets. The question is, how do they pull from these accounts to cover their budget and $13K in expenses without creating a tax bill? Here is the strategy we built with Joe and Linda, and it has two parts. Part one, they cover their entire $150,000 in living expenses from their brokerage account. Now, when they sell about $156,000 from their brokerage, they're not creating that much of taxable income. Remember, 40% of that income is their original capital. So when they sell from the brokerage, they are just getting their money back, and it's completely invisible to the IRS. The other $94,000 is capital gains. And because they've held these investments for more than a year, it's long-term capital gains. That $94,000 falls right into the 0% capital gains bracket we talked about. So even though it's technically taxable income, they pay zero taxes on it. So they're living completely tax-free on $156,000. But here is part two, and this is what makes this really strategic. They're taking that $32,200 standard deduction and using it to convert money from their traditional IRA to Roth IRA, tax-free. They convert $32,000 from their IRA to Roth. The standard deduction covers it completely, zero tax on conversion. So in 1 year, they're living on $156,000, converting $32,000 to Roth, and paying exactly zero taxes in federal income tax. But let's break down the total picture so you can see how this adds up. Total money flowing into their accounts, $156,000 for living expenses, plus they're moving $32,000 from traditional IRA to Roth. So they're looking at about $188,000 in total income. Now here's what shows up on their tax return as taxable income. $94,000 in capital gains, taxes 0%. $32,000 Roth conversion covered by the standard deduction at 0%. The total taxable income, $126,200. Their federal tax bill, zero. And here most people miss. They accessed $188,000 in actual money. The $62,000 return on capital from the brokerage is invisible to the IRS. And this is the difference between what the IRS sees and what you actually have to spend. And it's why having money in all the right buckets makes all the difference. And here is what happens when Joe and Linda turn 65. And this is where the strategy gets even more powerful. Their standard deduction increases to $35,500 because of that extra $1,600 per person for being over 65. Plus, if the additional deduction is extended, they qualify for that new senior deduction, an additional $12,000 for the couple. So now they're potentially working with over $47,000 they could convert to Roth completely tax-free every year. Their healthcare costs also drop significantly because they're now Medicare instead of paying for private insurance. So from 65 until they turn to Social Security, let's say it's 66 or even 70, and then until RMDs kick in at 75, they can keep running the same playbook. Leave off the brokerage account, convert as much as possible from traditional to Roth at zero at very low or zero taxes. And if an unexpected expense pops up, they can use Roth withdrawals for further tax-free income in retirement. Now, let me show you what happens when the market has a bad year, because this is where the flexibility really shows up. Let's say it's the following year. Joe and Linda are now 63. The market's down and they have some positions in their brokerage account that are sitting at a loss. They have about $20,000 in unrealized losses. Here is what we do. We harvest those losses. We sell those positions, realize the $20,000 loss, and immediately reinvest in similar but not identical investments to stay in the market. Now, here is how that $20,000 loss changes the math. They still need their $156,000 for living expenses from the brokerage account. But when they sell to get that $156,000, let's say they're harvesting $94,000 gains like before. That $20,000 loss offsets the $20,000 of those gains. So instead of having $94,000 in taxable capital gains, they now have only $74,000 in taxable capital gains. This creates $20,000 of additional room under that 0% capital gains threshold. So now they can convert not just $32,000 200 from their IRA to Roth using the standard deduction. They can convert an additional $20,000 on top of that, and it still falls in the 0% tax bracket. Total Roth conversion that year over $52,000. Tax bill still zero. So in a down market, when most retirees are worried and pulling back, Joe and Linda are actually able to move even more money into their Roth accounts tax-free. They're turning a market downturn into a tax planning opportunity. And any losses they don't use, those carry over to future years if they choose to take those losses. It's flexibility built into the system. But so here is what you need to know to make this work, because this strategy is not for everyone. First, you need a brokerage account with appreciated assets. Not just any brokerage account. You need positions with low cost basis that you have gains that you can harvest. If you just open a brokerage account last year, you probably don't have enough gains built up yet to make this work at scale. Because remember, if you hold positions for less than a year, then you actually have a short-term capital gains tax, which is taxed at your ordinary income tax bracket. Second, you need cash reserves or Roth balances to give you flexibility. When you're covering $156,000 in expenses, and some of that is return of capital, some is gains, you need other buckets to pull from to smooth things out or if something unexpected happens. Joe and Linda's Roth gives them that cushion. Third, and this is critical, you have to account for all of your income sources. Interest and dividends from your investment count as ordinary income. Rental income counts. Pension income counts. Any part-time work counts. So if Joe had a $40,000 pension, this whole strategy would look completely different because that pension income would eat up the standard deduction and start filling up the capital gains brackets. And fourth, you need to watch out for the alternative minimum tax scenarios. So at these income levels, it's rarely an issue, but it's something to model. Now, let me tell you about the 4 traps that can blow this up if you're not careful. Trap number 1, state taxes. Everything we've talked about is federal income tax. Many states have completely different rules, and some states like California treat capital gains as ordinary income. So you'd still owe state tax even with a $0 federal bill. The key is to know your state's rules. Trap number 2, ACA subsidies. If you're under 65 and you're on an Affordable Care Act health plan, your subsidies are based on your reported income. Even though you're paying $0 federal tax, that $126,000 of taxable income could eliminate or reduce your ACA subsidies. You might save on taxes, but lose thousands in healthcare subsidies. You have to run the numbers both ways. Trap number 3, Medicare IRMA. Once you hit Medicare, your Part B and Part D premiums are based on your income from 2 years ago. So if Joe and Linda have high income at 63, it affects their Medicare premiums at 65. IRMA kicks in at $206,000 for couples in 2026. They're well under that threshold. But if you're doing large IRA withdrawals to cover unexpected expenses, or lifestyle spending such as a new car or even doing more Roth conversions or have other income sources, you could push yourself into higher Medicare premium brackets without realizing it. And trap number 4, the different income calculations, AGI, MAGI, Modified MAGI. They're all different depending on what you're calculating. The IRS uses one calculation for your tax. ACA uses a different calculation for subsidies. Medicare uses yet another calculation for premiums. One number doesn't fit all. You have to model each one separately, and that's where a lot of planning falls short. So after seeing all of this, you might be wondering, could this work for me? And more importantly, how do I know? Here is what I've learned after helping hundreds of retirees plan their retirement income. The ones who have the most confidence aren't always the ones with the most money. They're the ones who have answers to the right questions. They know their asset location. Do you have money in all 3 buckets? Taxable brokerage, tax-deferred like IRAs and 401ks, and tax-free Roth accounts. If everything you have is sitting in a 401k, this exact strategy won't work for you. But knowing that now gives you time to build the right structure. Smart retirees also understand their milestone ages. At 62, you can take your early Social Security. At 65, Medicare kicks in and healthcare costs change dramatically. At 67, you hit full Social Security retirement age. At 70, you max out your Social Security benefit. At 75, RMDs start. Each of these ages creates different planning opportunities and different constraints. Joe and Linda's strategy at 62 looks very different from what it'll look like at 65 and different again at 70. They've integrated their tax planning into their complete picture. Not just taxes in isolation, but how taxes interact with healthcare costs, Social Security timing, spending needs, and legacy goals. It's a system that adapts as you move through retirement. In reality, here's what it really comes down to. Do you have clarity on your own numbers? Because Joe and Linda's strategy works for them, your strategy needs to work for you. And that starts with answering two fundamental questions. How much income does your portfolio actually need to generate each year in retirement? And are you on track to hit your spending goals, or will you fall short? If you want these answers for your own retirement, click the link below. Fill out a quick form and you'll get your personalized 5-minute video plan showing your numbers, your withdrawal rates, and whether you're on track within 48 hours. Thanks for watching, and I'll see you in the next video.